In today's episode, I'll talk about three interesting stories. In the first story of the day, I'll talk about HDB Financial Services' upcoming 12,500 crore rupee IPO and what it means for investors as well as the lending industry in India. In the second story of the day, I'll talk about India's struggling auto industry and what's really happening there, as well as what it really means for us as investors going forward. In the third and final story of the day, we'll take a look at Titan's latest quarterly results and what they tell us about India's jewelry market. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is simple to understand, yet is more comprehensive as compared to news channels. I'm your host Anurag Bansal, and today is Thursday, the 7th of November. Let's begin with the first story of the day. HDB Financial Services, which is a major player in India's lending sector, is now gearing up for a massive IPO. The company is aiming to raise 12,500 crore rupees on its public debut, which makes it one of the biggest IPOs ever by a NBFC or a non-banking financial company in India. To give you some background about it, HDB is the lending arm of HDFC Bank and manages over 90,000 crore rupees in assets. This IPO could transform the lending market, so to speak, by introducing a strong competitor with fresh capital to expand its reach. To give you some additional context beyond that, HDB operates as an NBFC, which means that it can lend money like a bank but does not quite offer any services like savings accounts. It lends to a broad audience across India, which includes individuals and businesses in both cities as well as in rural areas. Now, HDB's lending portfolio is split between secured and unsecured loans. About 71% of the loans are secured by assets like property or vehicles, which provides a bit of a safety net for HDB in case borrowers are not able to repay. The remaining 29% are unsecured loans, which lack collateral but earn a bit of a higher interest rate. Now, this mix gives HDB a balance between stable, low-risk income and the opportunity for higher returns. HDB, by the way, also runs a smaller but valuable BPO or a business process outsourcing operation. Here, they mostly provide services to HDFC Bank. This includes handling collections and other back office tasks as well. Now, while this segment only contributes about 7.7% to HDB's income, it is an added revenue stream that helps diversify its earnings. Talking about HDB's financials, they show a steady growth as well. Let's talk about net interest margin first, which is a measure of HDB's lending profitability. For FY 2024, its NIM was 7.85%, which is slightly down from 8.25% in the previous year. Now, this small dip indicates that HDB is facing rising costs or more competition, so to speak. The next one we'll talk about is profit after tax or PAT. Now, HDB's profits have been on the rise as of late. In FY 2024, they posted a PAT of 2,460 crore rupees, and this is up 25% from the previous year. The third thing that's important to look at here is non-performing assets or NPAs. Now, for those of you who do not know, NPAs refer to those loans which borrowers have struggled to make payments towards. HDB's gross NPAs are at 1.9% and net NPAs are at 0.63%, which are fairly low by industry standards. Now, this low level of bad loan highlights that HDB has a very careful approach to lending. Now, using the money raised from the IPO, HDB is planning to use the money in two important ways. The first way is building financial reserves. See, HDB will set aside 2,500 crore rupees from the IPO to strengthen its Tier 1 capital. Now, think of this as a financial cushion of sorts to protect HDB in case of any economic downturns or in cases of loan defaults. Now, this reserve will help HDB lend a lot more confidently and also meet regulatory standards while doing so. The second is offer for sale by HDFC Bank. See, the remaining 10,000 crores will be an offer for sale or OFS by HDFC Bank, which means that HDFC will sell a part of its stake in HDB to the public. Now, this move will give HDFC Bank additional liquidity and will also allow HDB to operate a little more independently in the public market. Now, as of now, the kind of market that HDB is, they are entering a very crowded field with some major players who already exist. The first one and possibly most notable one is Bajaj Finance. Bajaj Finance has an AUM of 2,44,830 crore rupees, and they are a giant in this sector while offering a wide range of profitable products. The second one is Cholamandalam Investment. This company specializes in vehicle financing and they hold an AUM of about 1,53,000 crores with a very strong position in this specific niche. The third one is Shriram Finance, which is known for its focus in commercial vehicle financing. Now, Shriram Finance has an AUM of 1,92,600 crore rupees with a very, very dedicated customer base. Now, compared to these very companies, HDB's AUM is just 90,000 crore rupees. But the good news is that it has steadily been growing at about 21% CAGR over the last 2 years or so. Now, with its focus on secured loans and low NPA levels, HDB has a very solid base in a highly competitive market. Today, HDB has a few unique strengths and potential challenges as well. And this is pretty important for us as investors to know about. I'll start with the strengths first. See, first is HDB's rural and semi-urban presence. Look, about 71% of HDB's branches are in Tier 3, Tier 4 and in rural areas of the country. These regions have fewer banking options which allow HDB to reach underbanked consumers and grow in less crowded markets which other players do not quite have access to. The second one is disciplined risk management. Look, by focusing on secured loans, HDB, so to speak, keeps its NPAs low and minimizes risk. This cautious approach also gives it a bit of an edge in maintaining stable as well as quality assets. Let's then move on to the challenges, starting with the first one, which is margin pressure. Look, HDB's NIM, like I previously mentioned, of 7.85% is slightly lower than last year's, which indicates that it might further face margin pressures if borrowing costs rise or if it has to offer more competitive rates in order to attract borrowers. The second one is their dependence on HDFC Bank for BPO revenue. Now, while this is also an advantage in some sense, if HDFC Bank does decide to change its outsourcing strategy, it could very heavily affect HDB BPO's earnings. This reliance on HDFC Bank also means that HDB may need to diversify its BPO client base in order to reduce this very risk. Now, back to the IPO, the timing of it seems to be very opportunistic. With a growing middle class in the country and rising credit demand, especially in smaller cities and rural areas, HDB is very well positioned to tap into a large market. Its strong lending base, low NPAs and extensive rural reach give it the potential for some good steady growth. But the challenge here will be to keep growing while managing risks carefully. Going public also means a lot more scrutiny from shareholders and new pressures to maintain growth without compromising on quality. So for investors like you and me, probably the question to ask here is, can HDB expand while keeping its disciplined approach intact in a very competitive field? Probably only time will tell. Let's now move on to the second story of the day and talk about India's struggling auto sector. Look, in September, India's auto sector hit a very rough patch. Sales dropped sharply across the board and left many wondering what exactly went wrong. Now, for anyone connected to this industry, manufacturers, dealers, investors, etc., it was a very concerning month. Let me give you a bit of a closer look at the reasons behind this dip and what it means for the future of this space. See, several factors of course have led to September's downturn in vehicle sales. I'll tell you what happened. The first thing is the economic slowdown. Look, the economy as a whole itself was not quite performing at its best. When people feel unsure about their finances, big purchases like cars and bikes often get delayed. The second possible reason is the floods in North India. Now, heavy rains have caused widespread flooding across parts of North India and have disrupted normal life. This has put a bit of a brake on vehicle purchases as people were naturally more focused on immediate needs rather than this. The third reason is Shraddh. Look, in India, Shraddh is a period of a few days when many people consider it inauspicious to make new purchases. This time around, Shraddh fell across most part of September, which typically leads to a big drop in sales for large items, including vehicles. So as a result of all of these factors, auto sales dropped by nearly 10% as compared to September of the previous year. Cars saw the biggest impact out of this and sales fell around 20%. Now this was a very sudden and unexpected drop for an industry that has, so to speak, been on an upward trajectory for the past few years. But to understand why this slowdown is exactly surprising, we'll have to rewind a little bit. Look, in recent years, India's auto sector has experienced significant growth like I mentioned. As the COVID-19 pandemic had eased, demand for vehicles surged pretty crazily. I'll tell you why again. A big reason for that was because people wanted their own vehicles to travel safely and avoid crowded public transport. This led to a boom in demand, especially for personal vehicles. The second reason is supply chain disruptions. Look, at the same time, global supply chain issues meant that manufacturers could not keep up with demand. This created two distinct outcomes: long waitlists for new vehicles and rising prices. Over the past 5 years or so, the price of an average passenger car in India has jumped by 50% from around 7.65 lakh rupees to 11.5 lakh rupees. So to catch up with this demand, auto companies gradually solved their supply issues and ramped up production. But by the time they did this, demand had unexpectedly faded down. Dealers which were once struggling to keep up with demand were now suddenly left with a backlog of unsold cars and piling in inventories. Some dealerships reported having stock that would last nearly 3 months without new sales. So to clear all of these excessive inventories, manufacturers began offering heavy discounts, sometimes as high as 3 lakh rupees on certain models of cars. And for the auto sector, this shift marked a low point, and September shaped up to be one of the weakest quarters in terms of growth over the past 2 years or so. But just as the industry was preparing for some more tough months, October brought an unexpected boost, so to speak. Now, October, for your context, is the festive season in India. There's Navratri and Diwali, which encourages people to make big purchases, inclusive of cars and two-wheelers. Now, this uptick in demand has helped reverse the sector's fortunes almost overnight, so to speak. Two-wheeler sales in particular saw a massive boost in October. Compared to the same month last year, most major manufacturers posted growth rates of over 25%. TVS Motors reported a nearly 40% increase in sales. Ola, which is a relatively new player in the Indian EV two-wheeler market, saw its sales jump by around 75% compared to last October. Passenger car sales also saw a very significant recovery. Most major car manufacturers recorded a growth of over 30% year-on-year in October and made up for September's bad slump. Companies like Mahindra and Toyota, which had managed to post some growth numbers even in the month of September, saw their sales spike by around 50% in the month of October. But interestingly, not every vehicle category benefited from the October boom. For example, tractors did not quite experience the same level of growth as the others did. Their sales growth slowed down and stood apart from the overall positive trend in the auto sector. But looking at the bigger picture now, the auto sector has consistently outpaced the broader market in terms of growth. Over the past few years or so, auto companies have been increasing their revenue and profit much faster than other companies in many other sectors. But the catch here is that the profit margins in the auto industry have lagged behind a little bit. Why, you might ask? Higher operating costs is the answer. See, automotive companies generally spend more to produce their vehicles as compared to other sectors, which affects their profitability. So while their revenues are growing, they are not as profitable as other industries are. And this year specifically, their margins may have taken an even bigger hit due to the discounts they were forced to offer in the recent months. Now, even though some input costs have decreased for sure, these discounts are likely to squeeze their profit margins even further. But now with the festive season almost behind us, November sales might start to see a bit of a dip once again as compared to last year. This is because Diwali had fallen in the month of November last year, which drove much of the month's demand. This year, Diwali purchases were mostly made in October, so it's only natural that November will be relatively quieter. But the real question here is what happens after November? See, October's spike in sales could have been a one-off due to the festive season. If demand does not pick up again, the auto industry may face further challenges with lower sales and shrinking profits. But if demand remains strong, we could see a return to normal sales trends with fewer discounts and possibly improved profit margins as the sector starts to stabilize. So in other words, October's resurgence is encouraging for sure, but it's maybe too early to say if it is a lasting recovery. For now, the auto industry has shown resilience, but the road ahead could still have a few bumps. With that, let's now move on to the third story of the day and talk about Titan's latest quarterly results. Now, the reason why it's important to talk about it is because Titan's result usually offers us insights into India's jewelry market and shifting consumer trends because of the sheer size at which the company operates. To give you context, Titan is the largest jewelry player in India and it generates over 90% of its revenue from jewelry alone. So therefore, Titan's performance is definitely helpful for us to gauge how Indian consumers are exactly spending on jewelry, which is a very crucial part of the Indian consumer market. Now, in the second quarter of FY 2025, Titan's consolidated revenue grew by 26% compared to the same period last year and reached about 13,600 crore rupees. Now, this growth was largely fueled by jewelry sales because earlier this year, the government cut the customs duty on gold and made gold jewelry cheaper. So this led to an uptick in gold purchases, especially during festivals and the wedding season when people traditionally buy more gold in India than they do usually. But even as revenue rose, Titan's profit after tax or PAT fell by 23% from last year. Now this drop in profit was driven by a few factors including higher advertising costs, increased interest expenses after acquiring CaratLane, and a few key shifts in the jewelry segment that we'll unpack in more detail. Now, jewelry is Titan's core segment like I mentioned, and sales here rose by a solid 25% this quarter. Yet, despite all this growth, the jewelry segment's profit margins dropped by 540 basis points and weighed on the overall profitability of the company. I'll break down why exactly this happened. The first reason, like I mentioned, is the impact of the customs duty cut. To give you some additional context, the government had slashed the customs duty on gold from 15% to 6%. While this definitely boosted sales, it also came with the downside for Titan. They had already purchased gold at a higher duty rate, which means that they needed to write down the value of their existing stock to match the newer price. So this led to a one-time expense of about 290 crore rupees, and Titan is anticipating a further 280 crore rupee hit in the next quarter as well. The next reason is a shift in consumer preferences. Look, due to the customs duty cut, demand has now shifted more towards pure gold items like bullion and coins, which usually have lower profit margins than studded jewelry. So while pure gold sales have increased in volume, so to speak, these lower margin products reduce the overall profitability. The next one is softer demand for solitaires. See, demand for large diamonds or solitaires also softened this quarter. One factor for this is global dip in demand, but there's also a new competitor in the market, which is lab-grown diamonds, which is something we've spoken about quite a bit in the past as well on this show. Now, these lab-grown diamonds look almost identical to natural diamonds, but the thing is they cost about 1/10, and that is why they appeal to budget-conscious buyers. Now, Titan's sibling company Trent has even started selling lab-grown diamonds in their jewelry brand Poem, which reflects the trend's growing popularity as well. Now, while Titan has not quite entered the lab-grown market yet, they are observing it very closely, and they have hinted that they might consider lab-grown diamonds if consumer interest continues to rise. Now, Titan's recent acquisition of Carrot Lane, which is a digital-first jewelry brand, has been a highlight this quarter. This quarter, Carrot Lane's income grew by 28%, and the studded jewelry category saw a substantial 41% growth, which now makes up 79% of Carrot Lane sales. In addition to this, Carrot Lane also expanded its physical presence and added about 11 new stores, which brought their total to 286 stores across 119 cities in India. Now, while jewelry is Titan's mainstay, so to speak, their watch and eyewear segments are also performing quite steadily. Their watch business grew by about 19% year over year, which was fueled by strong demand for analog watches, especially from premium brands like Titan and Helios. But their wearable segments, which is smartwatches, saw a slight decline here, likely due to intense competition and price pressures. Talking about Titan's eyewear business, that also grew, but at a modest 7%. But the thing is, they are revamping this business to attract a broader consumer base now. Titan's Eye Plus stores now feature a wide range of products from affordable frames to high-end sunglasses as well, in order to cater to different consumer segments. So in summary, Titan's quarterly results are not quite just about this company's performance. It also reflects a broader shift in India's consumer market and also the jewelry industry. Currently, since Titan is at crossroads, it is definitely worth watching how they will navigate these shifts and balance short-term hits with long-term opportunities. Let's now move on to the final section of the day, which is the news tidbits. First, Akasa Air reported a loss of 1670 crore rupees for FY 2024, which is up from 744 crore rupees in the previous year. Their revenue grew to 3144 crore rupees, which was driven by an expanded fleet of 24 planes, over 110 daily flights, and the launch of international services in March 2024. Second, from January 2025, India will impose stricter import restrictions on laptops, PCs, and other IT hardware. The new rules may require prior approval for imports and also set minimum quality standards. Now, this follows previous restrictions in 2023, which had limited success in reducing imports. About 60% of India's IT hardware is still imported, primarily from China. Third, the RBI or the Reserve Bank of India plans to broaden the use of rupee Vostro accounts, potentially enabling cross-border lending and loans to NRIs or non-residential Indians. A new framework could be introduced here within the next 6 months or so. Fourth, Reliance Jio's upcoming IPO is expected to raise over 52,000 crore rupees, with the listing likely in Q2 or Q3 of 2025. Its valuation is benchmarked against Airtel, which positions Jio as a leading telecom player in India's public markets. That's all the news and stories I have for you today. I hope you found value in this episode. Please do leave a comment down below if you've made it this far to tell us how you found this episode and also the things we can improve upon. I'll see you in tomorrow's episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.